Hello and welcome to The Trade. Before we get to the charts, let's take a look at what's making news. Japan's economy shrank almost 2%, excuse me, in the 3 months through to September, as the drop in exports in the face of US tariffs resulted in the first contraction in 6 quarters. President Trump saying the US may open talks with Venezuelan President Nicolas Maduro, who faces escalating pressure from Washington amid a massive US military build-up in the Caribbean. Asia's stock markets struck a cautious tone on Monday as traders looked ahead to a week of corporate earnings and catch up on US data with a focus on the interest rate outlook. And the Federal Aviation Administration in the States has said it would end mandated cuts in domestic flights, easing restrictions that have been imposed over air traffic control concerns during the federal shutdown. Let's now turn to the charts. David Scutt joining us from StoneX. Scotty, welcome back. Good to see you on this Monday. Now let's focus on the bond market, because I see that's where you're focused and you see some worrying signs. What are they?
G'day, Andrew. Great to be back. And yes, lots of focus this week, obviously, on NVIDIA and, of course, Berkshire Hathaway late last week unveiling a $4.3 billion new stake in Google, which has certainly gone and got the attention of markets today, especially US stock futures. But for me, it's the bond market, which is really showing some signs that I think the markets are not really paying enough attention to right now. And given the risk there, it could go and unravel this risk rally we're seeing in parts of the market right now. What you're looking at there, Andrew, is the US Ultra Bond contract traded on CBOT. This is a daily chart. And there's a couple of things that I'm looking at just from a directional standpoint. So this is price, of course, so it moves inverse to yields. So we're seeing a break on the downside of a rising wedge, which is called a bearish continuation pattern. So that points to downside risk for price, upside risk for yields. And then on top of that, I've just got an indicator with those arrows. We're looking at what's called a head and shoulders pattern at this point in time. And we haven't quite yet breached the neckline, but if we see the price go and slip beneath the 50-day moving average, which is shown in blue there, that implies both the wedge break and that head and shoulders pattern, that will see a big pullback. And what that means for yields is that they could go and see 30-year yields top 5% again, like they did when they were last there in September.
All right, so what is the catalyst for this? And potentially, how can you play it?
Yeah, interesting. A lot of this latest weakness that we're seeing coming through has all started around this talk about the tariff dividend from the Trump administration, this $2,000 check that was going to be sent out to medium and low income earners. Now, various estimates go and put the actual amount that would cost as double what the amount of revenue is being raised by tariffs so far this year. Now, clearly, when you already had a market that was on edge about the longer term fiscal trajectory of the US administration, if you were to go and start to go and add in extra on top of that, so to go and cut those outlays coming, or those revenues coming in, that's a pretty worrying sign. And that doesn't explain to me what's going on in that chart, because at this point in time, it just looks like we're seeing not just in the US, but a global shift where there's lots of talk of stimulus and not a lot of plan to go and plug the gap in primary deficits or the actual deficits themselves.
So, Scotty, if it transpires, we see those bond prices collapse, where are you seeing the assets that are likely to outperform as a result?
Yeah, look, we saw an example last week when it came to gold that has certainly had a nice rebound coming through there. You can see at this point in time, it hasn't gone and reclaimed those record highs, but it coincides with that renewed sell-off that we're seeing in long bonds. Kind of similar to what we saw with that Liberation Day rout in risk assets, and we saw a bid coming through in safe havens in that period of time. So gold is one of those areas that I expect to go and benefit. If you also look at what's been happening in the Swiss franc over the past week or so, it too has been very, very bid. So in the currency space, it's undoubtedly the number one safe haven out there. So if we see this continued sell-off coming through in long bonds, that would be the assets that I'll look to personally to go and protect and maybe see some upside. The ones I wouldn't want to go and be involved in are high beta risk assets, so the likes of Bitcoin, Ether, stocks, long duration stocks in particular would not handle it very well. And in the currency space, likes of Aussie dollar, Kiwi dollar would not go and benefit in such an environment because it would likely be accompanied by a risk-off tone.
And Scotty, I see you say Japan's bond market is playing its part as well.
Absolutely. And it's quite a similar scenario as well. So we've got a new government, of course, that's being put in place in Japan and looking to go and add some more stimulus into the fiscal side of the equation. And so what we're looking across there is 1, 2, 10, 20, 30, and 40-year yields across the curve there. And what we've seen today is there's been a continued backup in longer dated yields. So what does that mean? It means they are pushing higher as well, and in some instances hitting multi-decade highs. So you've got the US long bond market under pressure. You've got Japanese long bonds under pressure as well. In a global sense, if you've got those two trends taking place, it's likely to go and drag yields higher across other developed economies as well. So again, just going back to the original point, I don't think that risk assets and markets are paying enough attention to this move. When we've seen disorderly moves at the back end of yields in the past, it has not been a good environment for risk appetite.
And Scotty, another risk event this week is Nvidia's results. Interested to see what you're seeing on the chart because it has come off about 6% this month.
It has, and some of the signals on the chart as well do warn about the potential for some downside risk. That's the one area that we're going to look at in the chart coming up on your screen. The one thing I just want to talk about from a very fundamental perspective to begin with, though, is just what's priced in. Now, if you think back over earnings reports from NVIDIA, particularly in this AI hype phase that we're in at the moment, when was the last time they beat on top line? They didn't beat, sorry, on top line revenues. It's I don't even think there's an example of it. And Jensen Huang is always out there talking up a big game when it comes to the outlook. So that should be factored in to what the markets are expecting this week. Now, when you go and talk about what's already priced in, and you look at that price signal on the weekly charts, that's pretty concerning. So what we've got there is what's called a bearish engulfing candle. So that's a bearish reversal pattern. And that happened the week before last, and we saw follow-through selling again last week. At this point in time, it hasn't going to materialize by any significant degree. But as you can see down the bottom of that chart, when you get a big reversal pattern, it does have a tendency to go and play out in these stocks. So you can see there was a key bullish reversal, I should say, candle that printed earlier this year. So the fact that we've got an opposite kind of signal being shown on this occasion is warning traders, it's warning markets that this glamour stock in the AI space could be looking at some downside risk materializing in the not too distant future.
Scotty, great to get across what you're seeing on the charts. Thanks for joining us on StoneX.
Great to be here. Take care.
And that is The Trade.